All right, guys, welcome back to another episode of the Mogul Marathon Real Estate Podcast. I'm super excited for our guest today. Today, we have an amazing guest, Tom Dunkel. Now, Tom has over 25 years of real estate investment experience, and Tom brings extensive experience to his company, Belrose Storage Group. Now, taking the company from startup to world class organization, Tom has specialized in discounted asset opportunities nationwide since 2006. His financial savvy, open communicative manner, and integrity have seen him help alternative investors achieve their wealth building goals. And as a dedicated mentor to investors and entrepreneurs, Tom has also taught classes on real estate and mortgage note investment at CAMA Academy, along with Belrose Asset Management's co-founder, Joe Downs. And Tom is also a graduate of the University of Delaware, and Tom earned his MBA at the College of William and Mary. Tom, thanks so much for being on the show today.
Hey, Yannick, it's great to be with you and all the listeners today. Thanks for having me.
Sounds good. Well, Tom and I, just for a quick backstory, we were in the Raise Masters community. It's a community with Hunter Thompson, helps aspiring investors and active investors with their capital raising. And Tom is in the self-storage space. And before we jump into the details behind self-storage and his acquisition criteria, Tom, give our listeners a little bit about who you are and how you got to where you are today.
Sure. Thanks again, Yannick. Yeah, so I started out after business school in corporate America. So I was doing mergers and acquisitions and corporate finance work in the aerospace industry, and then software and IT services and logistics. So ran across multiple industries, but always doing deals and raising capital and that kind of thing. I had a great foundation. I was super lucky to be surrounded by amazing people, especially at the aerospace company. I worked with astronauts and ex-fighter pilots and Air Force colonels and ex-Marines, and just some really phenomenal leaders who had just had these great careers. And I just was lucky enough to be able to get in that environment and be surrounded by these great people. So it was a great foundation for me to then ultimately leave corporate America and get into my real estate career, which started abruptly in 2006 when I actually got fired from my corporate job, which was it was really the kick in the pants that I needed, though, to actually go out into the world and stake my own claim, because I had been wanting to do that, but how do you go about doing that? I had young kids at home at the time, so it never seemed like the right time. But when that event happened, it was like, all right, this is the sign. This is my opportunity to go do it. So that was 2006. Obviously, my timing for real estate probably couldn't have been worse. And so those next few years were really tough as the real estate market crashed, and I was a new entrepreneur trying to get my legs underneath me, and the markets basically crushing me along the way. But it forced me to just stay agile, get around the right people, and just stay committed and just stay gritty and hungry for what I wanted to do. So thankfully, I've been able to create a couple of really nice businesses in real estate. And I'm really excited to have been doing it for 16 years, going on 17, and we're having a really good time here at Belrose Storage Group.
That's amazing. It's so crazy that you pivoted after getting fired. Talk about that a little bit, because I think our listeners today might be in a situation where they're still working their W-2 job and they're trying to become a full-time syndicator, a full-time investor. But they just don't have that like extra motivation, maybe, right? Because it can be comfortable working a W-2 and you get paid every 2 weeks, and that's cool, right? There's nothing really to change. But for you, I mean, you got fired. I mean, that's pretty tough. How did you deal with that, getting into entrepreneurship as well?
Yeah, it was certainly not how I would recommend people go about starting their entrepreneurial career. I think it's probably better to, commit yourself to learning and getting around the right people. And if you're still working a W-2 job, which I would recommend, people continue to do that, and because you're going to have your health care and whatnot. Um, but take those nights and take those weekends and get educated, go to the seminars, hang out with people who are investing or are investors, and maybe hang out with some syndicators, or whatever it is that you want to learn, and just start picking up some things along the way. And hopefully you can maybe get involved in a deal. Maybe you can start raising some capital from your friends and family, and that way, if you find a sponsor that's raising money for a deal, maybe you can learn about that whole process by bringing some capital into the deal yourself. But I would just say, it all starts with just having that desire. You got to have that desire to want to make that change, because it's, for me, right, I had a cushy 6-figure job as a VP in a company, and stock options and all that, and I could have hung out there for a while. But I think it's important to have those goals, and just try to make something happen for you and your family.
Yeah, totally agree. Totally agree. And for context, I used to work for an asset management or private equity firm, and I became full time actually this past April. And that was kind of the same thing that I had when I was thinking about where I wanted to, what type of control that I want to have in my life, right? And I think, yeah, entrepreneurship, everything is on you, but also real estate gives you control, I think, right? From cash flow that you can live off of, and you can, um, also have profits that you can obviously grow within your business as well. The
Right.
thing with a job for me was I didn't want to have another person have so much control over my destiny. And I think a lot of people, um, they deal with that on a day-to-day basis, but certainly there's a mindset thing to that when you're jumping into the world of entrepreneurship, I think.
hmm Oh, 100%. Yeah, I remember being so frustrated in my corporate life. Like, here I was, really busting my butt, trying to get ahead, working late, getting there early, but a lot of times I felt like I was out of sync with my boss. Like, was I really working on the stuff that I was supposed to be working on? Am I doing a good job? Was I headed in the right direction? I get up for that promotion? Am I up for that raise? All that kind of stuff. It was all very mysterious, So now, having been an entrepreneur running my own company for 16 years, now it's, every day is crystal clear to me what I'm supposed to be working on.
Yeah.
So that's really what I enjoy, is, every day I feel like I'm having an impact and helping my business grow, helping my team grow. And so that's very satisfying for sure.
Yeah, it's pretty cool. Pretty cool. Okay,
Mhm.
so you're in the world of self storage, right? I actually was on your Instagram just surfing, and I saw you posting some things on about self storage and the resiliency
Mhm.
that self storage has to offer. Some of our listeners are in the multifamily space, they might be in the retail space, etc. But
Mhm.
particularly within self storage, give our listeners a little bit more context on how resilient self-storage has been given the inflationary environments that we've been dealing with over the past 12 months or so. you know how resilient are self-storage investments?
Sure. Yeah, that's a great question, Yannick. And it's one of the things that we love about self storage is, for 40 years, 40, 40 years, self storage facility occupancy rates have gently meandered between about 80% and 90% across the country. So, that, as an investor myself, I love to see that, because what does that mean? That means consistent income in good times, bad times, in between times, inflation, deflation, recessions, expansion, all of those time periods that have occurred in our economy over the last 40 years. Self storage just keeps cruising along, and so we really like that. And in the last couple of years, in particular, demand for self storage has really bumped up quite a bit, because when COVID hit and people were now working from home, that guest bedroom they have down the hallway that's, usually just maybe collecting a little dust, they had to turn that into an office, right? So they took the bedroom furniture, took it down to the local self-storage facility, and now they have their home office. So, and the other thing, of course, was people were going through a lot of turmoil in terms of their jobs and things like that, and so a lot of people were selling or trying to combine households. And so anytime there's that kind of displacement or disruption, divorce, death, all those D's, those are drivers for self-storage. So in bad times, people really need storage because they're running into those unfortunate circumstances. In good times, people are buying stuff and they buy too much and they need a place to store it, and they've got the money. It's not super expensive, and so we put them on an auto pay, and so it becomes like a Planet Fitness membership, where it's more of a hassle to try to cancel it than to just keep going with that $200 payment every month. So there's a lot of really strong drivers right now. One last stat I'll share with you, Yannick, is a few years back, the market penetration for self-storage, meaning the number of households that were using storage, was about 9%. Today, it's more like 10.5%. And I know a 1.5% doesn't sound like a lot, but when you consider there's 120 million households across the country, every 1% move is 1.2 million additional households that are looking to use storage. There's only 55,000 self-storage facilities in the country. So that's a lot of demand and not a lot of supply.
Yeah, that's perfect how you broke it down, and I can totally understand the demand factors that would be robust for self-storage. So where are you currently operating? What's your acquisition criteria? Give our listeners a little bit more context on that. If they're interested in getting into self-storage, where they can find those. Because I actually, we're primarily in the multifamily space. Our portfolio is in Baltimore, Maryland, and I looked for self-storage around my area and I couldn't find anything. So like, where are you finding these self-storage deals, and give our listeners a little bit more context on your acquisition criteria.
Yeah, sure. Well, today we're in 7 states. We're New York. We are in Maryland. We're in White Marsh, Maryland, actually. White Marsh Storage. They're right on Pulaski Highway, if you know where that is.
Yep, definitely.
Outside Baltimore. We're in Virginia, North Carolina, Georgia, Florida, and Kentucky as well. So what has drawn us to those markets are and it's similar to multifamily, Yannick. We're looking for a healthy economy, right? We're looking for at least steady population, if not population growth. We're looking for steady jobs and job growth. We're looking for solid per capita income. We're looking for lower poverty, lower crime, and we're looking for a diversified economy. So it's not a one factory kind of town that could be wiped out. And so we look at, and of course we're looking closely too at the competition. So first we look at the broader market, and then when we do find a specific facility, we're looking at the 1, 3, and 5 mile radius around those facilities, and we're really analyzing that competition. We calculate something called a supply index, which is a way of figuring how many square feet of self-storage is available in that market per capita in that market. So we like to see that number below 7 or 8. 7 or 8 is about equilibrium. If it's higher than that, 10, 11, 12, we see that a lot, like in Texas, which is why we haven't bought in Texas. That to us means that market is probably oversaturated with storage. The facilities we like to see and acquire are more like in the 3, 4, 5 feet of storage space per capita, and because that tells us that market might be undersupplied, and that there's going to be demand there that'll allow us to execute on our value add strategies, which is primarily pushing the rates up to market. But we're looking for, we don't acquire big facilities. We're more kind of what I'd say a smaller or middle market player. We're not trying to bang up against, the big private equity firms that have tons and tons of money. We're mostly in secondary and tertiary markets where there's still mom and pop owners that we're buying from, but there's still robust economies there. So those are the primary things we look for when we're acquiring a facility.
That's great. That's great. And it sounds like you mentioned, some of the similar demand drivers that maybe multifamily owners or just commercial real estate operators look for as well. Definitely strong population growth and income and all the things that you want to bolster, your property. Okay, so are you acquiring? You're in the middle market space, right? Are you looking at opportunities that have like what's the scale look like, right? Because I'm thinking in the self-storage space that just like anything, the bigger the better, right? You want to have some sort of scale behind it. Are you like vertically integrating in a sense from a perspective of acquiring different self-storage properties in close proximity to each other to maximize efficiencies and things of that nature? Give us a little bit context on that as well of maybe if that's in your acquisition plan as well and growth plan.
Yeah, sure. That's a great question, Yannick, and it is something that we are looking at as Belrose Storage Group continues to grow. We've just acquired our 11th facility. We've got over 250,000 square feet of storage now, over 2,000 units across those 7 states. And one of the things we are looking at strategically going forward is doing some of that ground up development, building those larger facilities, bringing that construction management aspect in-house, because right now we use outside general contractors with that. And there's a lot of companies in our space that are doing those kinds of things. And you hit on something else, which we really try to do as well. When we buy a facility in a particular market, we then go to those facilities in the area, maybe out, maybe 10, 15 miles, and we just give them a call, say, hey, we just acquired this facility. Love to get to know you. And, if you're interested in maybe looking at selling your facility, we certainly would love to talk to you about that so that we can get those economies of scale and so that our marketing can maybe, be more blanketed in that market, and our management of those facilities can be more efficient. So we absolutely look at that as well. And one of our value add strategies is acquiring facilities that have a little extra land, or like an old warehouse or something that we can convert into storage. So something we can do there to add more units and create some more scale for sure.
Yeah, totally agree. Okay, that sounds great. It sounds great. Okay, no, I really I think that acquisition strategy is really great, especially when it comes to vertical integration and trying to maximize efficiencies as much as possible.
Sure.
Because that's really what it's all about in the world of commercial real estate, is just trying to maximize your time. The smaller properties, yeah, they can make some money, but they also take a lot of time too, which I'm pretty sure you would agree as well.
Oh, 100%. Yeah, it takes as much time and effort to do a 10,000 square foot acquisition as it does to do a 50,000 square foot acquisition. So yeah, but of course we can make more money on the 50,000 square foot acquisition. So I like to be smart about it.
That's perfect. Okay, so you're acquiring these properties, and they obviously have some value add concept to it. How are you, maybe putting together a CapEx plan when you're looking at these properties that you feel that might have some extra value add, opportunities within it, so you can maybe attract, higher paying tenants or customers, and then maybe also I've heard a lot about the technology boost that's available out there to drive more traffic. Can you talk about that from a value add perspective?
Sure.
Well?
Yeah. 100%. Yeah. So I'd have to say one of the things I find really attractive about self-storage, and just again, as a reminder, I first and foremost, I'm an investor. I've actually been investing as a limited partner, as a passive partner in multifamily since 2013. So I'm very familiar with that asset class. And one of the things that I find really advantageous in the self-storage industry is our CapEx budgets are generally really modest. I mean, let's face it, at the end of the day, it's a metal box with a concrete floor and roll up doors. I mean, we're not trying to win any Architectural Digest awards at our facilities. We just want a clean, safe, secure, well lit place where customers feel comfortable coming in and storing their goods. So our CapEx plans typically consist of just maybe upgrading the gate and the gate software, and because each customer has their own unique entry code, and so that way we can kind of track who's coming and going. So that's where the software comes in, and then of course the fencing. If the fence needs to be repaired, or if we need to add barbed wire or something like that, we'll do that. If the asphalt is cracked or puddling or what have you, we'll do some grading and maybe some asphalting. Of course, roofs are important, just like in any other kind of structure. Make sure that the roofs are in good shape, and if not, we'll look to repair or replace those. But you touched on something else, Yannick, which is huge, and one of the things we bring to the table more so to create value that the moms and pops do not, is that technology. So when we take over a facility, a lot of times the mom and pop owner, they haven't really been leveraging technology. And a lot of times they're artificially keeping their rates low because they want to keep their occupancy high, because they don't really want to manage the facility, right? They want to spend time doing whatever it is they want to do. And the last thing they want to do is, run a website or, do Google Analytics or, implement any kind of, sophisticated technology. Actually, it's not even very sophisticated technology, but maybe as far as they're concerned, QR codes and things like that, maybe they think are sophisticated. But we come in and we put the facility on our software platform, and we're able to rent units to our customers straight from their smartphone. If a customer is driving by a facility and they're looking to rent a unit, there's a QR code right on the gate. They can scan that with their phone and just fill out their paperwork right there and go ahead they'll get a gate code, and they'll be able to go in. We'll direct them to their unit, and then they can just lift up the door and there's a lock waiting for them right there. And of course, all the we can also lock out delinquent customers. If they're delinquent, we'll make sure their gate code doesn't work. So that'll be sure to get us a phone call so we can make sure they catch up on their past due balance. So we use technology in those kinds of ways. And then, of course, from a management perspective, we can see, okay, how many move outs did we have? How many move ins did we have? What are our rate trends looking like? Do we have low demand for 5x5s and high demand for 10x20s? So we can kind of gear like how to market the units so we can keep them full. So I'm really proud about that we're able to use that technology to really maximize the value of the facility.
Yeah, I love the way that you're leveraging technology. I'm a big fan of technology, and I think, we're in the digital world in today's environment, right? Everything is going digital, and definitely positioning yourself in the marketplace to leverage those tools to drive the traffic, to have some of those systems and automations that can be tedious but are super, super helpful, I think is what allows operators to focus on the things that they actually need to do to drive the business forward. But then, like you mentioned, some of the reports and things of that nature and the data that you need to actually drive the revenue forward is easily accessible. I really love the way that you have that as well. And then also the technology aspect from a lease up perspective. I think in today's world, there are two things between speed and consistency that people really, really appreciate. And the example that I give is like Chick-fil-A, right? I've never had a bad experience at Chick-fil-A, because you know what you're going to get, and you get the speed when you go to get your food, right? So no, that's really amazing how you were able to create a business leveraging technology.
Yeah, 100%. And I left out the best part, Yannick, which is it helps us keep our personnel expenses very low, because we can have one manager using technology manage a facility remotely. So that allows us to keep our personnel expense down, which keeps our net operating income up and increases the value of the facility.
That's wonderful. That's wonderful. Okay, so you're in obviously in acquisition mode. I suggest, right? You're in acquisition mode, and the capital markets are just volatile today. It seems like you just never know where you're going to be pricing your loan at unless you lock in, earlier on. How are you looking at debt maybe when you're financing some of these acquisitions, and maybe protecting your investors from things that might come in the future? Although we do know from what you've mentioned that self-storage has been resilient.
Sure. Yeah, it's certainly been resilient, but of course, it's also subject to the ebbs and flows of the financial markets, like you were just talking about. So, and I guess thanks to my experience, right, I've been around for a little bit, so I've been seeing what's going on, and the uptick in rates recently was no surprise for us. So all year, here we are, December 2022. For this entire year, we've been underwriting our deals at higher interest rates, and we've been stress testing at higher rates and lower loan to value. And not only that, but we've been stress testing our exit cap rate assumptions, right? Because that can really swing a deal, from a good deal to or a great deal to only a good deal. So we've been stress testing that as well. We throughout the year, I think we started out getting rates like 3.95% on our debt. And then most recently, we've been getting term sheets at like 7.25%. So that's a big jump. And so, because my financial background and, our team is very conservative with our underwriting. So, we've been anticipating this uptick, and we've been planning for it, and also in our underwriting and our projections. And that's, again, just part of what we do is we really do take the job seriously of protecting our investors' capital, and we put money into every one of our deals. We have close friends and family in our deals, as well as we continue to attract new investors all the time. But I think the reason that they come back and they invest with us over and over again is because at my core, I'm a financial analyst and an investor, right? I'm not like a sales guy. So when a deal comes up, I'm looking for a lot of reasons to not do the deal. I'm not trying to, spin something to make a okay deal look like a good deal. Because I put my money where my mouth is. So I want to make sure it's going to be a good deal. So, we do stress test the models. We stress test the rent growth, the assumptions as well. So yeah, we've been around the block, so we know we like to under promise and over deliver, not the other way around.
Yeah, no, that's perfect. That's perfect. I think definitely agree with you 100% on making sure that your investors trust you, and they believe that you're putting skin in the game as well. I think especially when
That's right.
Things are turning around in the economy, some people might feel a little reluctant to place their capital, but I think putting your money where your mouth is super, super important. So I love the way that you invest with your investors, as well as we do the same as well. And just looking at these deals, I think in today's environment, given your corporate finance background, my background is in private equity as well. I think that has a lot to do with the training of how you look at deals as well, especially from doing that over and over again, and having that wheel turning constantly of like, why shouldn't I do this deal? From a risk aversion perspective, So I think that's really, really important for people that are getting into just commercial real estate in general, is how do you protect your downside in today's environment?
Yeah, 100%. And I think that's one of the things that's great, right, about whether it's multifamily or self-storage or medical office buildings, what have you. There's that dirt right underneath. It's not going anywhere. It's not going to zero. That's for sure. I mean, I lived through the internet bubble burst in the early 2000s, and stocks literally did go to zero. So thankfully, we're in a hard asset class that provides that security. It has an income, cash flow, and it has that growth potential. And those are, three things that investors are looking for, hoping for, maybe one or two of those, right? But I think, whether it's multifamily, self-storage, they provide all three of those: the security, income, and growth. That's why I love real estate investing.
Yeah, that's amazing. Okay, so Tom, you've been in real estate for quite some time now. 16 years is a lot of time. You've seen different cycles. You've been through. I mean, you started real estate and when the recession started, right? I mean, I think I was in the ninth grade.
Right before.
So
Right.
if you were to start this marathon all over again, right?
Mm-hmm.
What would you do differently that you think would contribute to your success?
Yeah, that's a great question. I think I think you've heard me use the word team a lot and get around the right people, and you can probably see this book over my shoulder here, Who Not How. I mean, the more I get into my career, the more I realize how important it is to have those good people around you, right? Have that team, and I think early on, because I had the solid education. I had the great experience with all those great people I mentioned at the beginning. I'd done a ton of deals. I'd done all the modeling and all that stuff. I kind of thought I was invincible when I first went out and got fired and booted into the world. And so I was like, all right, well, I'm just going to do this myself. I can do it. I've got this great background and whatnot. And that was just a wrong mindset, right? Just like on the football field, right? It's a team sport, right? All 12 guys got to be, or 11 guys, sorry, got to be.
There's no I in team. There's no I in team.
There's no I in team, and you know what? There's no I in real estate either. So I think it's important to make sure you're surrounding yourself with those good people. And I think had I done that earlier on, like in that 06, 07, 08 time frame, and it's not like I was totally by myself. I did have friends and mentors that helped me out, and it was just a very unique time. But I probably could have survived it a little better and maybe bounce back a little faster. But I'm super happy with where I am now. I think with Belrose Storage Group, we've really built it the right way. We've got a great team. We've got great access to capital, great access to deals. So I'm really excited about how we started this. But it's very different from how I started my first real estate business.
Yeah, that's great advice, man. That's great advice. I think a lot of people, especially maybe your type A personality folks who are the ones that are the go-getters and the ones who are the alpha males, a lot of times probably struggle with this, with just understanding that you need a team in this business, right? There are different facets of growing a private equity business, from a capital raising, a marketing, acquisitions, operations, and you can't, it's very challenging to scale a company when you're trying to do everything yourself. So I 100% agree. That's very, very solid, great advice.
Yep. Yeah, for sure. 100%. Yeah. We entrepreneurs, we like to, kind of smash through walls and bloody our noses and scrape our knees, just because we need to do it ourselves. And I think if I had changed my mindset earlier on, probably would have gone a little farther, a little faster. But like I said, I'm super happy with where we're at right now.
Yeah, that's wonderful. Okay, so if our listeners want to follow you, get in touch with your company, and potentially invest with your company as well, what's the best way for our listeners to follow you and do that?
Sure. Well, I appreciate it, Anik. This has been great. My name's Tom Dunkel. I'm the Chief Investment Officer at Belrose Storage Group, and we can be found at belrosestorategroup.com, where you can sign up in our investor portal, and that's where we communicate our upcoming investment opportunities with our investment community, with our investor community. And we also have some value add kinds of articles and podcasts and videos and things that we post on our Facebook page, at Belrose Storage Group Facebook page. And as you touched on earlier, Yannick, we're also on Instagram, Belrose Storage Group on there, where we post the same kinds of things. And again, as an investor myself, I just try to I'll try to just share whatever it is I'm seeing out there, whatever I'm learning. Just try to share that with our investor community, just to kind of help everybody, get educated, stay on top of things, see what's happening in the market, and then of course, see what's happening here at Belrose Storage Group.
Yeah, that's wonderful. Well, Tom, thank you so much for being a guest on our show today. We talked about your acquisition criteria, how you guys look at deals. We talked about vertical integration and the importance of that, leveraging technology in the self-storage space, financing deals today, looking at how you're looking at debt and just protecting your overall investor capital and the risk within the deal. So I think there was a lot of content for our listeners to really digest and think about when you're looking at self-storage opportunities. So thank you so much for being a guest on our show. Thank you for our listeners again for tuning in to another episode of the Mogul Marathon Real Estate Podcast. Let's be great today. Take action. And remember that real estate is a marathon, not a sprint. So run your own race. Thanks again, Tom.
100%. Thank you, Yannick. That was a lot of fun, buddy.